In 2006, a family in Ohio signed the paperwork for their first home. They had steady jobs, a small down payment, a dream that millions of Americans shared. Their mortgage broker smiled, handed them the keys, and told them not to worry about the interest rate. "In 6 months," he said, "you can refinance. You'll be fine." 2 years later, they lost everything. Their story wasn't unique. Between 2007 and 2010, more than 3.8 million American families received foreclosure notices. Millions more lost their jobs. $8 trillion in household wealth gone. And the people responsible? Most of them kept their bonuses. This is the story of the 2008 financial crisis, the crash that nearly destroyed the global economy, wiped out millions of ordinary families, and exposed the most reckless gamble in the history of modern banking. To understand how the 2008 crash happened, you need to go back to the years before it and understand just how intoxicating the housing boom felt to everyone living through it. In the early 2000s, after the dot-com crash and the shock of September 11th, the Federal Reserve slashed interest rates to near historic lows. Suddenly, borrowing money was cheap, and with cheap money came an explosion in home buying. Between 2000 and 2006, home prices across America rose by nearly 124%. People who had bought homes in the 1990s watched their properties double in value. New buyers rushed in, convinced that prices would keep rising forever. And on Wall Street, banks had discovered something extraordinary, a way to turn those mortgages into money. Here's how it worked. A bank would lend money to a home buyer. Then, instead of holding that mortgage and waiting decades for repayment, it would bundle thousands of mortgages together into a product called a mortgage-backed security, an MBS, and sell it to investors around the world. Suddenly, banks weren't in the business of lending money carefully and waiting for repayment. They were in the business of writing as many mortgages as possible, packaging them up, and selling them off. The faster they sold, the more they made, and nobody on Wall Street wanted to slow down. With this new model in place, banks faced a problem. There were only so many credit-worthy borrowers, people with good jobs, strong credit, and reliable income, and those borrowers had already bought homes. To keep the machine running, banks needed more mortgages, so they changed the rules. The subprime mortgage was born. Subprime loans were designed for borrowers who previously wouldn't have qualified, people with poor credit histories, unstable income, or no savings for a down payment. Lenders offered them mortgages they couldn't really afford, with adjustable interest rates that started low but were set to climb sharply after a year or two. The pitch to borrowers was always the same: don't worry about the rate going up. By the time it does, your home will be worth more. Just refinance. It was a bet that housing prices would never fall. Mortgage brokers, paid in commissions, had every incentive to write as many loans as possible and zero incentive to care whether borrowers could actually repay them. Banks had every incentive to bundle these mortgages and sell them as quickly as possible. Wall Street had every incentive to buy them because the fees were enormous. And when investors worried about the risk, rating agencies, the same firms supposed to be objectively assessing the safety of these products, gave them AAA ratings, the highest possible mark, safer than almost anything else you could buy. By 2006, 1 in 5 mortgages written in America was subprime. The machine was running at full speed. But deep inside the machine, cracks were forming.
In 2006, housing prices stopped rising. At first, it seemed like a minor correction, a pause, the kind of thing that happens in every market before the next surge upward. But the loans that had been written in 2004, 2005, and 2006, the subprime mortgages with their low introductory rates, were starting to reset. Interest payments that families had been able to manage suddenly jumped by hundreds of dollars a month. Defaults began, slowly at first, then faster. And as more homeowners defaulted, the value of those mortgage-backed securities, the products that Wall Street had sold to investors around the world, began to collapse. Here's where the crisis went from bad to catastrophic. It turned out that major financial institutions hadn't just been selling these mortgage products to others, they had also been buying them themselves in enormous quantities, using borrowed money. The leverage ratios were staggering. Some firms had borrowed $40 or $50 for every dollar of their own capital. When the value of those assets started to fall, the losses were multiplied, and nobody knew exactly how exposed anyone was, because the products were so complex, so layered with derivatives and side bets, that even the banks that created them couldn't fully understand what they owned. The first major casualty came in March 2008. Bear Stearns, one of Wall Street's oldest and most respected investment banks, collapsed almost overnight. Its two largest hedge funds, loaded with mortgage-backed securities, had already failed. The Federal Reserve brokered an emergency sale to J.P. Morgan Chase for $2 a share. The stock had been trading at $170 just a year before. Then came the moment that changed everything. On September 15, 2008, Lehman Brothers, as we covered in a previous video on this channel, filed for bankruptcy. $613 billion in debt, the largest bankruptcy in American history. This time, the government didn't intervene. The message to the market was terrifying. Nobody was too big to save. And if Lehman could fail, who was next? Credit markets seized up almost overnight. Banks stopped lending to each other. Businesses across America couldn't access the short-term borrowing they needed to make payroll. The entire financial system was on the edge of complete collapse. The response from Washington was unlike anything America had seen since the Great Depression. In September and October 2008, the U.S. Treasury and Federal Reserve launched a series of emergency interventions that would have seemed unthinkable just months earlier. The Fed rescued insurance giant AIG with an $85 billion emergency loan. AIG had written hundreds of billions in insurance contracts on mortgage-backed securities, and when those securities collapsed, it couldn't pay. Its failure would have taken down banks around the world. Congress passed the Troubled Asset Relief Program, TARP, authorizing $700 billion to stabilize the banking system. The government effectively became a part owner of America's largest banks. It worked, barely. The complete collapse of the financial system was prevented. But for millions of ordinary Americans, the rescue came too late, or not at all. Between 2007 and 2010, 8.7 million Americans lost their jobs. Home prices fell an average of 30% nationally, wiping out trillions in household wealth. Retirement accounts were devastated. College savings were gone. The financial institutions that caused the crisis? Most were bailed out. Most of their executives kept their jobs. Many kept their bonuses. One study found that not a single senior Wall Street executive went to prison for their role in the crash that cost millions of Americans everything. More than 15 years later, the 2008 financial crisis remains the defining economic event of a generation. But here's what still haunts it. The people who designed the system, the mortgage brokers, the bankers, the rating agencies, the regulators, weren't stupid. They knew the risks. Many of them understood at some level that what they were building was fragile. They kept building anyway, because the incentives said keep going, because the bonuses were tied to this year's performance, not next year's collapse. Because if you were the one who slowed down, someone else would take your clients and your market share. Because when an entire system is rewarding recklessness and punishing caution, most people choose the reward. Michael Burry,
one of the few people who correctly predicted the crash and bet against the housing market, described watching the crisis unfold as being in a room where everyone could see the fire starting, but nobody wanted to be the first to say it out loud. The 2008 financial crisis wasn't caused by a few bad actors making secret decisions in the dark. It was caused by millions of decisions made in the open, by people who should have known better, in a system that gave them every reason to look the other way. And that's the most unsettling lesson of all. Because that system, the one that rewards short-term thinking and socializes the cost of failure, is still in place. The 2008 crash didn't come out of nowhere, and neither do the collapses we cover every week on this channel. From Enron to Lehman to FTX, the pattern keeps repeating. If you want to understand how these disasters happen and how to see them coming, subscribe. New financial collapse every week. And drop a comment. Do you think the people responsible for 2008 got the justice they deserved, or did they walk away too easily? Thanks for watching Financial Collapse. I'll see you in the next one.